Welcome, everyone. This presentation is brought to you on behalf of the SDSMA Center for Physician Resources and Foster Group, LLC. A Physician's Guide to Wealth Preservation is the first of 5 programs we will hold on the topic of personal finances. And while this presentation will focus on wealth preservation, additional programs will be held on the topics of wealth protection, wealth enhancement, wealth transfer, and charitable giving. At this time, I'm going to turn it over to Kent Kramer. Kent will tell us a little bit about himself and Foster Group, and then he will lead us through tonight's discussion.
Currently serve over 850 clients in over 35 states, and we manage about $1.3 billion today. And I think what's interesting maybe for this audience is over 50% of our clients, the people that we work with, are physicians, either active or retired. So we have some good experience working with doctors, and we enjoy that very much. I'm a lead advisor with Foster Group and also am on our investment committee and our co-chief investment officer. And in this presentation, we're going to talk about something along the topic of wealth preservation. And for us, wealth preservation has to do with the way people invest their assets. And many people accumulate assets over time. You know, depending on where you are in your investing career, you may have just begun to accumulate those, or you may be further along and have significant assets at this point. And when we're thinking about preservation, a lot of people will say, well, why not investment growth? And what we want to focus on is, I think what a lot of people focus on is, once I earn this, invest this, and see some growth, how do I keep it? And so we're going to talk about that in this presentation. But this is just one of what we found to be 5 key concerns of physicians when it comes to their financial circumstances. And in addition to wealth preservation, so of these 5 key concerns, I just mentioned a little bit about wealth preservation, but the other 4 that are going to be subjects of other articles and webinars done by the Medical Association. Wealth protection has to do with oftentimes insurance or protecting assets from unjust taking or catastrophe. Wealth enhancement has to do with the tax management of your resources, so that you handle things in the most tax effective, tax efficient way possible, as well as understanding how cash flow works. Wealth transfer has to do with people who are interested in, how do I transfer the assets I've accumulated from one generation to the next, or possibly in the case of a physician who owns a practice, how do I go through the sale of that practice, transferring my interest in the practice to someone else, usually through some kind of liquidity event where you're trading off a business interest for some kind of a financial or cash purchase. And then the last area of charitable giving, for people who are charitably inclined, who have some intent, there are some very effective ways to go about doing your charitable giving. And what's interesting is all 5 of these areas, they're very interrelated in how we approach them. So some of the things that we think about in terms of how we manage a portfolio impact directly actually on something like charitable giving. And some of the articles you'll see later will have to do with, how do I give using appreciated securities, for example, which can be a very tax-effective way to go about gifting, but it can also be a very helpful thing to do when it comes to kind of tax-efficiently repositioning your portfolio. But those are for another time. We just want to show how these 5 areas fit together. Today, this idea of wealth preservation, we're going to use the theme evidence-based medicine, which is one I think you're probably all familiar with. A little personal story here. I've had 4 spine-related surgeries in the last 8 years, personally. So the idea of evidence-based medicine is pretty important to me because I've wanted a good outcome. 2.5 years ago, I had my last surgery, which has been very successful. But just my own story in that is, my surgeon had us do some very non-invasive or kind of the lowest risk surgeries possible for a few years, because the science around treating the problem that I had was still developing. And his thought was, hey, if we can just kind of keep you going for a while, I think the science is going to get to the point where we're going to be able to give you a much better solution maybe in 5 years than right now. So if we can wait, I think we can provide you with a better solution. Sure enough, what happened about 3 years ago, there was some advancing in the use of what's called a bone morphogenic protein, which again is something you're all familiar with, BMP, but it allows for the use of synthetic proteins in spinal fusion. And it's been very successful for me, but it wasn't as well tested or as available when I initially started having problems, actually 20 years ago, and when we started even looking at surgery as much as 10 years ago. Maybe kind of the classic example of evidence-based medicine was one of these studies, and I'm going to just use one of them here around the use of corticosteroids in treating premature babies or babies who are scheduled to be born prematurely. This idea of evidence-based medicine, if you look at these quotes here from the Center for Evidence-Based Medicine in Oxford, it's evidence-based medicine is the conscientious, explicit, and judicious use, and then this key phrase of current best evidence in making decisions about the care of individual patients. So the idea is we want to use treatments that are based on solid evidence. And why do we want to do that? Well, in medicine we want to do that because it's the risk versus benefit. What we want is we want to have a high probability of a good outcome for patients. And as more evidence becomes available for certain kinds of medical treatments, the idea is, hey, the likelihood of a good outcome for a patient increases if we feel more and more solid about the evidence around the testing, around those treatments or pharmaceuticals. And hopefully what we have as time goes on with this evidence-based medicine is we find solutions or treatments that are both persistent, they work across time, multiple tests through different periods of time, and they're pervasive. They work amongst all different kinds of cases or individuals. So they're not limited to a specific time in history or a specific necessarily narrow population, but the best evidence-based results occur if those solutions are both persistent, they don't seem to fail over time, and they're pervasive. They work in as many populations as possible. So again, kind of referring to this classic study here on corticosteroids for preterm birth, the story here was in 1972 was the first randomized controlled trial for this kind of a treatment where the birth mother of a baby who was going to be born prematurely was injected with a steroid because the baby is underdeveloped at this point and they were looking for ways to improve the health of the child right prior to birth. Well, it showed a dramatic improvement in the likelihood of a healthy birth and a healthy child and development by doing that. Then from 72 to 89, there were 6 more studies. So again, they're going for this kind of persistency and pervasiveness in studying the result of this treatment. Sure enough, they find a 30 to 50% reduction in infant mortality through this treatment. So it proved to be persistent and pervasive, and then it finally became standard practice in 1989. So that's quite a gap, 1972 to 1989, as the science developed, as the tests were made, and then finally, as a practice standard, this was adopted really globally. A couple observations here about this idea of evidence-based medicine as it applies to this particular case. One is we see a dramatic increase in the probability of success. I mean, a 30 to 50% reduction in infant mortality is significant. So the probability of success for that preterm baby went up dramatically as a result of this evidence-based approach. The other thing that I'd note, though, is that the dissemination of information is critical. It took from 1972 to 1989 for this to become standard practice, before it became kind of widespread in its acceptance. Why is that? Well, anytime we're introducing some kind of a new solution or new science, it takes a while because it may be contradicting the existing science or the existing practice. And we want to make sure before we depart from what we've been doing that the new thing that we're going to do actually makes sense. It provides us with an increased probability of success. So in the same way, when we look at investing, evidence-based investing, I think we can apply the same principles. And what's been happening in financial economics and investing over the last 40 to 50 years has just been a burgeoning of science, of actually evidence around the study of, well, how do markets work and how is it that investors have a successful experience across their lifespan. And while this slide is likely too small for you to read some of the specifics there, if you look back, going back into the 1950s, there was a gentleman named Harry Markowitz who did some of the first work on why diversification really reduces risk. We kind of knew it, intuitively, but he actually put the science to it and did the statistical proofs around diversification and portfolio risk management. And it's now become what's called modern portfolio theory. So Markowitz was really the father of that idea. Later on along this timeline, you just see other kind of landmarks in the development of financial science or investment science Behavior of Securities Prices by Paul Samuelson at MIT in the 60s, and then The Efficient Market Hypothesis by Gene Fama at the University of Chicago, again later in the 60s. Kind of switching gears here, going farther forward, something called the size effect, which we're going to touch on in a little bit, was finally kind of put to proof by Rolf Bantz, again at the University of Chicago. And really one of the kind of the summary works done around this whole area of multi-factor asset pricing, again by Gene Fama and Ken French at the University of Chicago. The reason I put all these up here is just to show that just like in medicine you have kind of an advancing science and advancing science of treatment, in investing there's an advancing science of how to handle portfolio assets and how people have a successful experience. And so what we want to talk about in this presentation about wealth preservation is, well, how do I apply the science? What does the science tell us about how an investor should behave, how they should deploy their assets? And I'm going to go through just a series of principles here that stem out of this research work done over the last 50 years. The first one is this, is that markets work. Actually, I would put it this way, I think markets win. And what I mean by that is markets, by their very nature, work because millions of people every day are doing transactions. They're buying and selling securities. And in each transaction, there's a buyer and a seller. And if you think about that for a minute, the buyer is buying because they think the price is right for them, and the seller is selling because they think the price is right for them. So there's an agreement as to the general value of the security or the thing that is being bought and sold. So the market is working, it's efficient in a sense, because you have these millions of buyers and sellers who are arriving at pricing decisions every day, and what happens throughout the world really as securities transact is securities are priced fairly because both sides have a vested interest in getting a good price, in arriving at a fair price. And if you have enough people who are transacting every day in these markets all over the world, we can be pretty confident that the prices that are being reflected by the securities in the markets are fair because so many buyers and sellers are agreeing on that price. Another way to look at it is a quote here by Charlie Ellis, who's kind of a father of investment management. And one of the things that he talks about here is this idea, well, a lot of people think they want to try to beat the market. Again, I think markets win. And Ellis puts it this way, always interesting, often fascinating, and sometimes exhilarating, the work of competing to beat the market has been getting harder and harder and has now become extraordinarily difficult. Most investors are not beating the market is beating them. And Ellis is relying on all kinds of data that we're going to look at in a little bit that would show just how consistently the market is winning, how consistently the market is beating investors. But what's interesting about this is today over 90% of all transactions in the marketplace are done by institutional investors. These are professional investors with lots of research money behind them trying to make good decisions as to what to buy and sell. If you think about the level of competition in markets today, it's extremely high. The likelihood of a big error or a persistent error in pricing is low, simply because so many people, so many professionals are trying to transact in the market every day. So this idea that somebody's going to consistently beat the market would say, well, somebody's going to be able to beat all these institutions that are spending all this money and all this time on research on a consistent basis, and it just doesn't seem to make sense. And it's not going to prove out in the data either. Why is that the case? Well, let's think about this just for a minute from the point of view of arithmetic, if you will. If we think about the market as a whole, and by the market we can define it a lot of different ways, but let's just use as our definition of the market for this illustration the idea of all the stocks available in the world today. So every single stock publicly available within the United States and around the world makes up what we're going to call the market. And within that market, there are millions of transactions happening every day and all kinds of different investors making this pricing decision. And as a result of it, every day there's a return of the market. And that return of the market is the average experience of every investor participating in those securities transactions. Now, there's a couple different ways to think about investing in the market today. And one group wants to try and beat the market. And traditionally, we call that approach active management. And they're going to use things like security selection, In other words, they're going to try and pick IBM versus Apple. They're going to try and pick GM versus Ford. So they're going to try and pick which stock is going to perform better than the other. That'd be a security selection decision. Or they may use market timing. They may decide, when am I going to buy this stock and when am I going to sell it? Today's the right day to sell, tomorrow's the right day to buy. So those are two ways to go about trying to beat the market, because rather than participating in the entire market all the time, they're choosing to participate in a small section of the market for maybe a period of the time. That would be active management. The passive or market investor says, I'm going to make the market my ally. So rather than trying to compete against the market, I just want to get the return of the market. The market's return is good enough for me. So instead of competing, I'm going to try to get on the same side and make it my ally. Now, for the passive investor, or for the market-based investor in this case, what they're saying is, and I've represented it by that small slice on the bottom, is they're saying, look, I'm willing to take the return of the market. So if you think about the two populations of investors, both populations on average get the return of the market. Because if I take all those passive investors and I just remove them from the market, what they are taking with them is a pro rata share of every security in the market. So they take the market return and they leave and say, thank you very much, I'm happy to get the return of the market. What's left then is the other part of the market, which is also on average, all those investors are getting the return of the market, so it's no different than the passive investor. It's just that they're all getting different returns that make up the average market return. So some days some people beat the market, but some days some people lose. There's winners and losers every day in that active part of the universe. But on average, that active management universe is getting the return of the market. At least that's what's available to them. So what's the difference? Who wins between the active investor or the passive investor? Well, it costs money to participate in markets. So if both groups, on average, have available to them the average return of the market, the only difference between the two groups' return as a whole is what they paid to participate. So it's the return of the market less fees and expenses is what the return to the investor actually makes up. So the question is, when you look at the two ways to invest, well, which one costs the most? Because, again, just by math, if both groups on average are going to get the return of the market, the difference between the two groups' return is going to be found in what did they pay to invest in that market. And what you find is the group with the lowest fees and expenses is the passive investor. They're paying less than the active investor as a rule. Now, what's the difference? How much less do they pay? That depends on how you measure, but oftentimes the numbers that I see statistically thrown around are a passive investor can invest in the U.S. market for less than 0.25% on average. An active investor investing in the U.S. market may pay more than 1% on average to participate in the U.S. market. That's a difference of 0.75%, which again, on the whole, makes up the difference between the two average returns. The average return of the active investor in that market situation would be the market less 1%. The average return to the passive investor would be the return of the market less 0.25%. That's a lot to follow, but the math is pretty straightforward. Again, return of the market less fees and expenses is return to investors. So if I can reduce my expenses and still get the return of the market, I'm doing well. Is that really the only thing I should keep my eyes on? This study here is one called the Behavior Gap, is what we call it. It's done by a investment organization called Dalbar, and it gets renewed every year. And what this is doing is kind of coming at the question in a different way. It's saying, hey, if I look at all the investors in stock funds and compare their average returns against the stock market indexes that they're invested in, what's the difference in return? And what you can see on the far left here, in this 20-year period, ended in December of 2011, the S&P 500 index, which is just a benchmark of the 500 largest companies publicly available for trading in the United States, if you look at that index, which is available to passive market investors, versus what the average stock fund investor got in the same time period, what you see is the market index returned 9.1% over that time period, while the average stock fund investor only received a 3.8% return. Now that differential, almost better than 5%, is what people call the behavior gap. If you think back to just a minute ago, we talked about the difference in return being just fees and expenses, and I said, well, the difference in fees and expenses might be 0.75%. This differential is a lot bigger than that difference in fees and expenses. And the reason for the differential is because there's something else going on besides just the fees and expenses, and it has to do with investor behavior. And again, what kind of the big picture outcome of this study is, time after time, is that active management as a whole, people trying to outperform the market, actually rather than allowing them to outperform the market, is causing them to underperform the market by larger and larger amounts. So that difference between the market neutral return, the S&P 500 in this case, and the stock fund investors' return of 3.8% is somewhat related to fees, but obviously a lot of it is related to behavior or decision making along the way. And you can see the same gap exists for investors who are participating in bonds versus just the bond market as a whole. This is another study kind of showing a similar thing, and all it's doing here, it's looking at different ways to slice the investment market up. You can look at U.S. large company stocks, U.S. mid-cap stocks, U.S. small company stocks, and at any time you can do the research and say, of all the professional money managers out there who are trying to beat an index or be compared to an index, a portion of the market, what you find is that the majority of those active managers are failing over some period of time. In this case, we're looking at a 5-year period ended December 2012, that the majority of them are failing to match or beat the market index. Again, just kind of go back to that first statement of markets not only working, but it appears that markets often win. And so for the investor who has simply invested in the market, or these different kinds of markets during this time period, they would have been ahead of the professional management approach when it comes to an actively managed fund, in this case, in any of these different market indices. This is just looking at the same data but applying it to bonds, and you can see kind of a similar set of information here. And this is just in a 5-year period. If we were to show this in a 10 and 15-year period, the numbers just get worse. It's more and more difficult the longer period of time you go to stay ahead of or compete with the market. So some people will say, well, I don't want to invest in just any manager. What if I just pick the best managers? I mean, aren't there some people out there who do this on a consistent basis and can beat the market? It's a great question. It's a logical one to ask. You would think there'd be some top people out there, and certainly in any given period of time there are managers or individuals who beat the market. The question is, can they persistently do it? Can they consistently do it over time? This is another study here, and in this study we look at all the managers of U.S. equity funds over a 5-year period, in this case 2002 through 2006, and what we do on the left-hand side is we stack up all those manager results and we say, hey, the top quartile, 377 funds out of the 1,500 available for measurement, we just say those 377, hey, they were the best performers. They were in the top quartile of all performers during that 5-year period. So if you're an investor in January of 2007 looking to decide, well, who should I hire to manage my money, you might look at, well, who's been the best performing manager in the past? I would expect that they might have the best chance to be the best performer in the future. I wish that were true, but what we find in this study is that of those top quartile managers, of the 377 funds, only 32 of those funds remained top quartile in the next 5-year period. So only 8% of the 377 stayed top quartile from 2007 to 2011. The more difficult statistic, though, is go down to the bottom. Of those 377 top performers, 175 of them, 46%, dropped to the bottom quartile. 55 of them, or 15%, did not even survive during the next 5-year period. They actually went out of business because of likely poor performance. So you had over 60% of the top quartile from 2002 to 2006 either dropping into the bottom or not surviving in the next 5 years. Again, kind of giving the lie to this idea that, well, performance is going to be persistent in this type of an approach, and what you find is it's just not. We can't really look at past performance, at least in the active management universe, and say it's going to persist into the future. So here's Bill Sharp kind of making some conclusions about this idea of active management. And he says, more often the conclusion in support of active management can only be justified by assuming that the laws of arithmetic, again that's at fees and expenses, have been suspended for the convenience of those who choose to pursue careers as active managers. And Sharp's got his tongue firmly inserted in his cheek there, but what he's saying is the statistics around active management really don't seem to work to the investor's advantage. If we go back to this idea of evidence-based medicine and evidence-based investing, what's happening in this part, or in this part of the study, is that something that we believe to be true, that if I just apply myself, if I use good information, I should be able to beat the market. What we find is, while we'd like that to be true, in actual experience it doesn't appear to be true. The evidence doesn't support that. So rather than relying on an active management approach, what we feel one of the first principles of evidence-based investing should be is we move away from active management to more of a passive or market approach to managing the portfolio. And this last slide, I know you can't read this one, but it just shows a teeter-totter, and again it's the idea that the weight of evidence for passive investing or for investing in the market as opposed to an active approach, academically the weight of evidence is just overwhelmingly in favor of the passive approach. And so if we're going to go where the data leads us, we feel like passive investing or investing in markets is the way to go. And that's a key first step here in understanding evidence-based investing. So with that in mind, let's move on to the other principles here. The next one has to do with diversification. And if you think about this one, it's going to make a lot of sense, because if I want to get the return of the market, what is the best way, what's the highest probability way to get the return of the market? Let's say the market has 1,000 securities in it. Would I have a higher probability of getting the return of the market if I invested in just 10 of those securities, or if I invested in all 1,000? I mean, the math would tell us that, well, if I can invest in all 1,000, the likelihood of me getting the return of that 1,000 stocks is higher than if I just pick 10. Because of those 10, if one doesn't do well, my return may look significantly different than the market. So diversification becomes a question of opportunity set. Where is it, and what kind of stock should I be invested in? And I put this slide up for us to look at because in terms of diversification, this is a picture of what's called global market capitalization. And all it's showing is, hey, where do the opportunities to invest exist? And if you look at the United States at 46%, what it's saying is 46% of world stock market value exists in companies domiciled within the United States. So 46% of my opportunity set as a stock investor exists in U.S. stocks. That means 54% of my opportunity set exists outside the United States. And of that 54%, 15% of that opportunity set is emerging markets, and 39% exists in developed markets around the world. What this is arguing for is, for the investor who wants the return of the market in a global sense, we have to be globally diversified. We can't be just a U.S. stock market investor, because the opportunity set, over half of it, exists outside of the borders of the United States. This is another way of looking at some similar information here about diversification. This chart, sometimes we ask people, really with a kind of a comical intent in mind, we say, hey, look at that chart, and then tell me if you can see a pattern in it. And of course, there really isn't a pattern. What the chart is doing is just ranking from highest return to lowest return the stock market returns of individual countries year by year. And the point of the chart is there is no pattern. Some years, a certain company, like in 2012, Belgium is at the top of the list. The year before, it was down there at number 5. The year before that, it was 4 from the bottom. The idea with looking at a chart like this is depending on the year, one country may significantly outperform other countries. But there's just no pattern. There's no predictability as to which country will be the best performer. So as a globally diversified investor, if I believe that active management doesn't work, what I'm faced with is, well, I need to participate in the global market all the time, across all time periods, if I want to get that global market return. We're going to look a little bit more about that in the future, but the point here is the opportunity set is the world, and when we look at that world opportunity set, there's really no predicting which part of the world will be the best performer from year to year. So the better approach is to stay diversified all around the world all the time to make sure that we get the return of the market as a whole that we're going for. This next principle is really going to get more into the academics behind some of those studies we looked at earlier in the specifics. And I like to call this one structure determines performance, because if we think about the way that we structure our portfolio, we do have some control on how much risk we want to introduce to our portfolio. And what we're going to find is, in investing, like everything else, there's really no free lunch. And so if we want to increase the return of our portfolio, we're going to find that we're going to need to be willing to accept increased risk in order to try and increase that level of return. One of the real classic studies about risk and return and structure was done by Brinson and Biebauer, and it was redone in '91. It was done originally in the '60s. But what they did is they looked at the return of pension funds over time, and they tried to identify the determinants of the differences in the returns of these funds. And when they looked at the differences, what was determining the differences statistically, what they found was asset allocation made the dramatic amount of difference. 91% of the difference they thought could be explained by asset allocation of the portfolio. And what they mean by asset allocation is how much of the portfolio was in stocks, how much was in bonds, how much was in large companies, how much was in small. It didn't have anything to do with when the portfolio manager was buying or selling. It didn't have to do with any specific securities, was it IBM or Apple. It had to do with this idea of asset allocation, what broad categories of investment and in what percentage of those broad categories was the underlying portfolio invested. In some subsequent work trying to identify, well, within asset allocation, are there decisions that investors can make that weight their portfolio differently? This is the work done by Fama and French that we looked at earlier in that investment timeline. And what Fama and French did is they took that idea of asset allocation and said, are there particular asset classes or particular parts of the market that give us consistently greater return for some risk exposure that we're willing to take? And what they found was there were basically 5 risk factors that investors could count on. They were persistent, they were pervasive across all different kinds of investment types. And what they found was that investors who wanted to increase return could reliably look at something called the market factor. And this is something we all, I think, understand. The idea of if I invest in stocks versus bonds, over time, stocks tend to have a higher return than bonds. That would be the market factor, stocks versus bonds or cash. But in addition to that market factor, they also quantified what was called the size factor, and then I'm going to use the word value factor, or the price of the security. But the size factor just said smaller companies tended to outperform larger companies, and more value-ish companies, companies with higher book-to-market ratios, tended to outperform growth companies. And if you look at this chart, those 3 bars on the left, they just show the degree to which those factors influence the return of the portfolio. In other words, the premium associated with investing in the market versus investing in treasury bills. There's a premium associated with investing in small company stocks. That premium is 3.6% above investing in just large stocks. The premium investing in a value stock is almost 5% relative to investing in a growth stock. Now, those premiums were achieved over time. They're an annualized difference, but they're achieved over a long period of time. We're going to look at that chart here in a second. On the bond side, they also identified two other factors. One was the maturity factor, so how long does this bond have to run? Is it a 1 year to maturity or 10 year to maturity? And then credit factor. And by that they meant what was the quality of the issuer. And what they found is the lower the quality of the issuer, there was actually a premium associated with buying that lower quality bond. It wasn't a great premium, as you can see there, but there was a slight premium associated with it. So these 5 factors are determining or helping to determine the expected return of the investment portfolio. You go back to that asset allocation decision that Brinson and Biebauer looked at. What they found is the same information here. The asset allocation has to do how much in stocks, how much in large versus small, how much in value versus growth, and how much in bonds and what kind of bonds. That's the asset allocation decision. For any investor looking at making that structural decision, one of the things to keep in mind is that for most investors, we're after something called real return. And so when we're thinking about the structure of the portfolio, we want to beat inflation over time. And again, what these studies would indicate is that stocks are the most reliable investment for beating inflation over time, though they don't do it every year. But for an investor who wants to have a real return, who wants to stay ahead of inflation over long periods of time, you're going to need to employ some significant exposure to stocks to do that. So let's look at these premiums and how they occur. This is the market premium, and the thing to note about this chart is the premium doesn't occur every year. So this market premium, the difference that an investor can receive by investing in stocks over treasury bills, while the average premium over this period of time was almost 8%, you didn't get that 8% every year. Some years, the light blue bars, I got the premium or even more. Other years, the black bars, I received actually a negative premium. I was penalized for investing in stocks as opposed to bonds. But for the long-term investor who's invested in the market, over time, they're accessing that market premium. In a similar way, here's the size premium. Again, doesn't occur every year. It kind of occurs in streaks, really, if you look at it going back. But statistically, it's found to be a reliable premium. It's persistent over time. It's pervasive across different markets. That premium there shown over this period of time is 3.6% for the investor who stayed consistently invested in small company stocks over the entire time period. And the last one is the value premium. Same thing, we're looking at the premium of value stocks minus growth stocks. The premium's pretty strong when you look at those light blue bars above the chart, but again, there are always going to be years when that premium doesn't hold. And so the investor has to be consistently invested day after day, year after year, in order to capture the premium when it exists. Going back to that kind of persistence idea or pervasiveness as well, you can apply those premiums, the size premium and the value premium. You can say, well, you've shown me how it works with U.S. large company stocks. Is it pervasive? Does it exist in other markets outside of the United States? And this chart would say, well, yeah, it does. That size and value premium exists not only just in U.S. large company stocks, it exists within U.S. small company stocks, it exists in developed markets around the world outside of the U.S., it even exists in emerging markets. And you can see the premiums in each one of these areas of stock market allocations around the world and in the United States, that they are pervasive premiums. So statistically, we go back to I want an evidence-based approach to the way I build my portfolio. The evidence appears to be there that these factors, the market factor, the size factor, and the value factor, tend to exist in all different kinds of markets over all different kinds of time periods. So if we're constructing our portfolio and we want to take advantage of these things, in a very simple picture, what we're saying is if we start with market neutral, in other words, that big market, what I want to be able to do is I want to be able to tilt my portfolio and own asset classes that represent more value-ish stocks and smaller stocks. I don't necessarily want to avoid completely large growth stocks, but I may want to own far less of them in my asset allocation, because in an attempt to increase my expected return, it looks to me like the statistics, the evidence shows I have a better chance of increasing my return if I accept a little risk, a little more risk by going towards a more value-ish or a smaller exposure in my stock portfolio. So structure really has to do with managing risk and preserving liquidity, and the other part of this asset allocation decision we've been talking about kind of the stock market part of our portfolio. The other part of the portfolio has to do with, well, if I want to mitigate stock market risk, the best way to do that has to be owning bonds. Because what we find is bonds are a lower risk asset, which again, it's that no free lunch idea. If I want to increase my return, I have to be willing to accept the risk that comes with owning stocks. If I want to reduce my risk, I'm going to introduce more bonds to the portfolio. And depending on the individual investor, both their temperament and their circumstantial needs for how much liquidity protection, how much cash on hand they may need more or less in the way of bonds in their portfolio. What the data is going to show is that for investors who really want to preserve liquidity and manage risk, they're going to experience kind of the biggest bang for the buck if they employ short-term, high-quality bonds in doing that. This is just a simple chart, and what this chart is showing that the annual compound return of the different maturities of bonds over time, starting on the left-hand axis there with 1-month Treasury bills and going all the way out to the right to 20-year U.S. government bonds. What you see in the light blue line is there is an increase in return as you lengthen the maturity of the bond. The darker blue line, the annualized standard deviation, is measuring the riskiness or the value, the way that value of that bond fluctuates over time from day to day, month to month, year to year. And what you see is that 1-month Treasury bill has a very low standard deviation, 1.49% in this measurement, versus an average return over this time period of 5.2. If you go left to right, what you see is the annualized compound return increases as the maturity lengthens, but somewhere between 1 and 5 years, the standard deviation associated with increasing the length of maturity really starts to go up faster, relatively speaking, than the increased return that you get by lengthening the maturity. What investment science would say is, the trade-off here, risk for return, seems to be somewhere between that 1 and 5 year area, seems to be kind of the sweet spot for the mix of what's my expected return from my bond maturity and a trade-off against annualized standard deviation as a measure of risk. So in the portfolios that we're looking at, we would say, let's take the risk. In other words, let's go for more return with the stock market part of the portfolio, and let's try and control that risk and protect our liquidity as much as we need to by using shorter-term, higher-quality bonds. Next principle has to do with counting costs. Again, kind of go back to our first illustration. For the investor, the return to the investor equals the return of the market less fees and expenses. Fees and expenses are something we can actually control. Here's the equation. Just talked about that briefly. But the idea here is, and this chart just shows the effect of a different percentage fee on an invested portfolio over time, and you can just see the dramatic difference to the investor that a rising fee makes. You can see that light blue line reflects a 1% fee against investment over time versus a 2 and 3, and you can just see the dramatic difference in the cash available to the investor after a 20 or 30 year time period by exposure to a different level of fees. The other thing that we'd want to say about fees are this: some people think that, well, the higher the fee must mean a more sophisticated approach to investing. Isn't it the case that if I'm paying more, I should be getting more? In the investment world, that really doesn't seem to hold water very well. Again, this is a study just of high expense versus low expense funds and their relative performance. And what you see here, particularly in U.S. markets, large company funds, mid-cap stock funds, small stock funds, is that the higher expense funds actually have a lower return to the investor, which from our math exercise at the front end is what you'd expect, but oftentimes what the industry wants to tell you is that, well, the more sophisticated strategy costs more, and that more sophisticated strategy should generate a higher return to you, the investor. What this study is showing is, as a whole, that doesn't seem to work. That the higher expense funds, on average, have a lower return to investor than the lower expense funds, and certainly then just participating in the markets as represented by the indexes like an S&P 500, the 400, or the 600 there on this chart. Okay, so those are kind of some basic principles that we need to keep in mind when we build our portfolio. The next thing is, how do I do this? What kind of steps do I need to take? What we recommend for every investor is that they have something called an investment policy statement that they have in writing that governs kind of how their portfolio is going to be constructed, and that they can look back to, so that when times get difficult, when markets get more volatile, they can look back and say, well, why did I choose this portfolio in the first place? And what you want to do is you want a policy statement because, again, this is Ellis writing here, the hardest work in investing is not intellectual, it's emotional. Not figuring out the optimal investment policy, it's sustaining long-term focus at market highs and market lows and staying committed to sound investment policy. And in this statement, policy is the most effective antidote to panic. We go back to that slide we looked at earlier, the one that we called the behavior gap. What we're trying to do with an investment policy is prevent ourselves from making bad behavior decisions that are going to reduce our return over time because we choose to react to a short-term market situation. We think we can actively manage something, whether it's timing or a security selection. We start to fiddle with the portfolio at precisely the wrong time. And at the end of the day, we look back and go, if I had just stayed in whatever my policy portfolio was, I would have been better off. An investment policy statement helps us to manage our own behavior. So in your investment policy statement, these are some things you may want to have written down. The purpose of the portfolio. Why are you putting this portfolio together? Is it for retirement? Is it for education? Is it for something else? If it's for retirement and you're 45 years old and retirement is still 20 years away before you retire, and by the way, when you retire at 65, you might live to 100, the time horizon in that portfolio at 45 is still a 55-year time horizon that this thing has to work. It's a very long-term investment approach. As opposed to maybe education, you've got some children, let's say that you have a 10-year-old and you're investing for their college expenses. That portfolio has 8 years until you need to begin to use it, maybe 12 years till it's going to be completely gone. Completely different time horizon and a completely different purpose for that portfolio. So those first two, the purpose for the portfolio and time horizon, are very important considerations as you consider what kind of investments that you're going to put to work. For most of our portfolios, global market history would say you probably ought to have a 5 to 8 year liquidity requirement. And what that means is if you are going to need cash, whatever amount it is, in the next 5 to 8 years, that is probably not good money to put into a stock market investment. You'd be better served by having the things that you need to access in the next 5 to 8 years invested in some kind of a bond portfolio. And again, we would refer you to the data on short-term high-quality bonds as the place to start. And then for those longer-term portions of your portfolio, so retirement or education's a long way away, whatever it might be, then you want to put in place, well, what are my structural decisions? How much of that market factor do I want? How much market risk am I willing to take to achieve my investment goals? So how much in stocks versus bonds? If I look at my world opportunity set, how much do I want to have invested domestically in the United States versus outside of the borders of the United States? Keeping those kind of weights in mind. 46% of the opportunity set exists currently in the United States, 54% outside. And then when we look at kind of financial research, how much do I want to dedicate in my portfolio to those size and value risk factors? In other words, I'm willing to take on some additional risk by participating at a greater degree in the smaller and more value-ish part of the market. Then finally, bond quality and maturity parameters. That would go back again to the liquidity requirements from the portfolio, and we would point you there again. If you have liquidity requirements, short-term high-quality bonds are the way to go. If you're looking for a longer-term bond portfolio, you may want to make that maturity slightly longer, maybe take on a little more credit risk. Those are risk factors. But again, we find that if you really want to get the bang for your buck in terms of your risk exposures, stocks have the highest return relative to the kinds of risk that you're willing to take. Passive versus active management. We kind of tried to make that case early that we think passive management or market-based management makes all the sense in the world versus active. And then how often you're going to rebalance the portfolio. And what that means is once you put these policy weights in place, let's say you choose a 60% stock, 40% bond portfolio, how often are you going to look at that stock-bond mix and rebalance it or take it back to your policy weight. So this year is a good example. It's been a pretty good year for stocks in 2013. A person who started the year in a 60% stock portfolio, 40% bond, may find that their portfolio today looks more like a 63 or 64% stock portfolio with correspondingly less in bonds. They may need to sell 3 or 4% of their stocks to rebalance it back to that policy allocation of 60-40. There's no magic frequency for rebalancing. The important thing is that you do it at regular intervals. Some people choose to do it quarterly, semi-annually, annually. Any of those things can work. You just want to have that written down and a reminder set so you're looking at that portfolio regularly to bring it back to your policy weight decisions. This is just a picture of what a fully diversified portfolio might look like, and what I'd point you to here in terms of your personal investment policy is that pie chart picture. All we're doing here is we're just showing, hey, these are the policy weights for a fully diversified portfolio. And in this case, what you can see here, model portfolio 1 represents just 60% in a U.S. S&P 500 index and 40% in the broad bond market. Model portfolio 5 shows that by using some of those other factors, by diversifying internationally, by using some small company and value company exposures, in this case, that same 60-40 allocation, you can see the return is increasing to over 11%, and yet the standard deviation, the measure of risk at 11.39, is not significantly different from the standard deviation of just the straight 60-40 using the S&P 500 and the U.S. government bond market, government corporate bond market index. So we're just showing that it is possible to increase the return of the portfolio using structural decision making. There hasn't been any market timing done in that. There hasn't been any security selection. It's just an asset allocation decision to expose the portfolio to some of those risk factors along the way. Finally, personalization. How do you determine what your stock bond mix should look like? What we'd argue for here is the need for personal financial planning. You know, whether you want to employ someone to help you do this or try and think through this yourself, what you're asking yourself to do is, I need to manage risk for long-term financial independence. That's kind of the goal of managing a retirement portfolio. And not only do I need long-term financial independence, I need to make sure in the near term that I've done a good job with preserving capital and liquidity so it's available when I need it. There's a variety of ways to do that. Normally what happens is you kind of look at a person's savings pattern, what their projected spending pattern is over time, and then you try and back into using a series of numbers. And a lot of these calculators are available online, but we'd encourage you to look maybe at a couple of the calculators first that would say, well, how much do I need to save and what kind of rate of return do I need to have in place? But the things to keep in mind is your portfolio is going to be personalized to you. You want to make sure when you're asking these kind of questions, you're saying, well, how much can I save over time? The other side of that question is, what does my lifestyle cost now, and what is it going to cost in the future? This is just a simple chart. The red line in this chart is just showing the cost of living increasing at 4% a year. And what we like to show people when we show them this chart is, you know, what feels like maybe a $5,000 cost today, if you look out 20, 30 years in the future, that same $5,000 of purchasing power is going to take $15,000 to $20,000 of cash flow in order to do the same thing, to support the same lifestyle. So you want to be real careful when you're thinking about planning your policy portfolio that you keep in mind that you need a real rate of return. You're going to be trading off some amount of risk for the kind of return necessary to get you into a portfolio that will create that financial independence that you need long term. And these are numbers that are too small for any of us to read, but it's just the idea that behind all these kind of decision making, you're going to want someone who can help you model some numbers. And I would just encourage you, as you get closer to retirement or as you begin to accumulate some significant investment assets, it might really be a good idea to at least see someone either on a one-time basis or develop an ongoing relationship with an advisor who can help you kind of answer the questions that you have, model the portfolio ideas that we've talked about here, and particularly model those portfolio ideas relative to your current portfolio, your future savings expectations, and your future spending goals, so that you have a good sense of, hey, this is where we're going, this is what it's going to take to get there, and you can have some confidence. Because again, you're going to need to go back and develop that investment policy statement that you can stick with and know why it is you put that thing in place to begin with. Okay, I've thrown an awful lot at you in this thing to consider, so let me stop and ask if there are any questions that anybody has or any points of clarification you'd like me to make about any of the ideas we've talked about.
Thank you, Kent. This is Mark, and I just wanted to throw out a couple questions to you. I know we're kind of coming up on our hour here, but one of the first questions I had, and you touched on this a little bit, is how does a person get started? I mean, most of us probably have some investments already, not sure where we're at in terms of how we're balanced out. And so what would your recommendation be for getting started?
Yeah, that's a great question, Mark. So for many of us, one of the first places we're going to participate in investments is in our 401k at work. There's going to be a retirement plan there. What I would suggest you do there is look at your investment choices that are available to you. And one of the things you might do is in the past you may have just been looking at what the past returns for those funds have been. Rather than just looking at the past returns of the investment options, you may want to look at which one of my options are actively managed versus passively managed. And the passively managed ones will stick out because they'll say something like the S&P 500 Index Fund or the Russell 1000 Index Fund. Those kinds of things are good indicators of, hey, maybe these are passive or market-based investments that based on some of the data I've seen today, I might want to consider in my portfolio. The other thing you can look at in your 401k plan is look at the expense ratios of the funds. One of the things you have control over, again, is controlling the cost exposure that you put your portfolio to. And again, what we've seen, and the data would seem to indicate, that the lower cost funds provide a higher probability of success for the investor. So if you can combine kind of in that initial look at your investments, looking for index-based or asset class-based investments that are carrying a low cost, those are good, what I'd say kind of starting points for building blocks for your portfolio. The other thing that I'd look at, again, if you kind of want to go further, is you can start by building a pie chart, and there's a number of places online that you can do this. One of them is a company called Morningstar. They have a website where you can actually go to and you can plug in the names of your funds, and it'll show you a pie chart of, well, how much of my funds are invested in the United States versus outside the United States. How much of my funds are invested in large company stocks versus small. So if you kind of want to start to do it yourself, those would be the evaluations that I'd make. The other thing you can do, obviously, is you can go and visit with an investment advisor, and maybe your plan actually is connected to a larger company. It'd be worth asking somebody there at that larger company. Let's say your plan is with Fidelity or Schwab or Principal or somebody else. They're going to have an 800 number. You can call them up and say, look, I just heard this presentation on asset allocation and evidence-based investing. I'd like to see a pie chart of how I'm currently invested in terms of how much of my investments are active versus passive, how much is in the United States versus outside of the United States. And they'll be able to answer those questions for you to give you a start.
Okay, thank you, Ken. One other question I had was, we're starting to see some changes in interest rates, and interest rates are starting to come up. How do you see that, or how does that impact rate of return?
Yeah, and that's a really important question right now. Interest rates around the world have been historically low, for years now due to the global financial crisis and central banks lowering rates. One of the things that investors kind of need to remember is that the price of bonds and interest rates are inversely related, meaning that when interest rates fall, the value of the bond begins to rise. So if I owned a bond at, let's say, a 5% interest rate, and now interest rates begin to lower, my 5% coupon bond, in terms of its value, is going to start to rise, because instead of people having bonds available that are paying 5% coupons, the new bonds are only paying 4 or 3. So people are willing to pay more for that higher coupon bond. So here we are in this low interest rate environment, and now the inverse is kind of the risk, if you will. As interest rates start to rise, the likelihood is that longer-term bonds will see their values fall. So there's volatility associated with those longer-term bonds, especially if and when interest rates start to rise. And we saw some interest rates rise already this year in May and June. So kind of going back to our discussion earlier, one of the things that an investor should keep in mind is one way to avoid some of that interest rate risk, the risk associated with rising interest rates, is to own shorter term, higher quality bonds. The shorter term bonds, let's say I own a 1-year bond, well, it's going to mature, and when it matures, I get my principal back, and now I can invest immediately at the now higher interest rate bonds that are available. So the investor who buys short-term bonds has the opportunity to see his bonds mature and then reinvest at the new and higher interest rates as interest rates start to rise. The person who's buying longer-term bonds, while they may have a higher coupon, the problem with that longer-term bond is the value of the bond will likely fall as interest rates rise. And the thing that happens long-term is that rate that looked pretty good today associated with the long-term bond, as interest rates climb, those interest rates may climb right past the interest rate that's currently owned on that longer-term bond. So you have a big opportunity cost that could be lost by owning a longer-term bond at a lower interest rate. So kind of to summarize, what we go back to and say, we think the shorter-term, higher-quality bonds are almost always a sensible way to think about the bond market, but particularly for people who are investing new dollars today in their portfolio, that short-term high-quality exposure is going to make the most sense given where we are on the interest rate curve and the likelihood of interest rate increases here in the next number of years.
Okay, thank you. Kent, we have just a couple more minutes here before our time runs out, but I did want to put one more question to you, and that is in regard to, you talked about our IPS statement and our plan. What is the best way to remove the emotional component of it? Because for many of us, we watch our investments and we monitor and they go up and down, and so how do you eliminate that element?
Yeah, boy. I wish there was a fail-safe way to do that for all of us. I remember talking to one, actually a professional investor, professor, and he said, well, the best thing to do is make your investment decisions, put them in an envelope, and then open them back up in 20 years and you'll be fine. Now, for some people that might work, but for most of us it doesn't, right? So one of the things that I think an investor needs to be able to do is once you kind of decide on that policy allocation, and I would say this, I think for almost every investor, a blended portfolio allocation, in other words, a blend of stocks and bonds makes sense. And from a behavioral standpoint, here's why. Because if you have both stocks and bonds, particularly short-term high-quality bonds in the portfolio, there's always going to be something in there that is not losing money. And for all of us, just from a behavioral point of view, we need to be able to find something in our portfolio that's doing reasonably well. So first step is you just have to use diversification to your benefit, not only from a kind of a science standpoint, but also just from managing our own behavior. The other thing I'd say is for the investments that you put in your portfolio, so let's say that you choose I'm going to own 20% of my portfolio is going to be in U.S. large company stocks. One of the things that can give you peace of mind is look at the fund you've chosen and benchmark it against that. Let's say you say, well, this is a U.S. large company stock investment. I'm going to benchmark it against U.S. large company stock. So I'm always going to say my U.S. large company stock fund, I'm going to look at it relative to what the S&P 500 is doing. And as long as my U.S. large company stock fund is doing pretty much the same thing as the S&P 500, then I look back and go, well, I'm invested in U.S. large company stocks for a reason. I think long term I need the diversification that comes with owning stocks. I want to own this much of U.S. stocks. If the performance of my fund versus that benchmark index appears to be reasonably close, then I can be comfortable that I'm getting the return of the market. Because remember, what we're after, at least in our point of view, is if markets win, they not only work but they win, if I'm getting the return of the market, I should do well over time. There are going to be some times when the return of the market is disappointing. I mean, it's no fun to see markets go down. But if my long-term approach is I want to get the return of the market and I'm confident that the market return is the best way to achieve kind of a good lifetime investment experience, then as long as my investments are tracking their market-based benchmarks, I can stay comfortable, at least to some degree, even though I'm seeing those investments maybe go down in value in the short term. But that's a really important question. It's hard for people to keep that in mind because they tend to look at it and they go, gosh, U.S. stock market is going down. This is time to get out. And then that leads us right into that behavior decision where we're making behavior choices at exactly the wrong time, because the two big enemies for investors have always been fear and greed. Fear will cause us to sell when things are falling, which is a very bad time to sell. And greed will cause us to buy when things are very high, which is a very bad time to buy. Because the basic rule in investment success is I want to buy low and I want to sell high. And if I get into the fear and greed cycle, I'm going to be doing exactly the opposite of those things, which is why that investment policy statement is so important, because we can look back to that and go, that's my instrument panel, and if I'm flying and it feels rough, I can look at my instrument panel and go, am I still level? Is my policy allocation still in place? And we're going to rely on that instrument panel of the investment policy statement to keep us flying, in a level way, even when things feel particularly rough in the environment around us.
Okay, thank you. Well, Kent, as we wrap this up, I want to say again thank you to you and your crew for all the time and effort and resources you put forth in this initiative. We think this is truly a valuable project and want to thank you again for presenting today. Before I part, I want to say a couple of things, and one is to remind all of our members to go ahead and go online to the Center for Physician Resources website, in which there are a host of articles and white papers that have been developed on the topics of wealth preservation, wealth protection, and more coming. And so, Kent, I would also ask that maybe you put a note out there in terms of if people have questions, how they can contact you or members of your team to have some of their questions answered.
We absolutely would be happy to do that. Always happy to do that. Yeah.
And what would be the best way to contact you, Kent?
Well, the best way to contact me is via email is probably the simplest. It's Kent K, K-E-N-T-K, at fostergrp.com. That's my email address. And if you just go to our website, which is fostergrp.com, www.fostergrp.com, my contact information is on there along with other investment advisors here at the firm. We'd be happy to get back to you with whatever information we can.
Okay, great. Thank you. I'm going to go ahead and hit pause and record. And again, I want to thank everybody for coming today.